Hey guys, it's Brett here, directors. Good afternoon. Thank you for joining today's live. So today I want to talk about escrow, but kind of in two different forms. I mean, a lot of you guys are familiar with or potentially, hey, the escrow company helping with the closing of a real estate transaction, purchase or refi. But then you've probably also heard an escrow account or an impound account that is used as part of my monthly mortgage payments to help with tax and insurance. So I'll dive into both today for us. So let's first talk about escrow. That's the company helping through closing. So some states in the US are escrow states, others are attorney states. Now it's the same idea, kind of a neutral third party between lender, buyer, seller, and real estate agents, kind of this neutral third party, right? So the role of escrow really is to kind of manage the flow of money coming in is the number one piece. So at the end of the day, you guys make an offer on a house. Your offer's been accepted. That contract is sent to escrow as kind of that neutral third party. They will open up an escrow or like a transaction around that. Now, as part of it is their goal is all money flows through escrow. So as you do an earnest money deposit, it sits in escrow. As you do eventual down payment, it goes to escrow. They disperse the money out per the contract. So for example, if you were to release your earnest money, that's giving permission to escrow to release that to the sellers. So they're going to abide by the contract. Traditionally, an earnest money deposit, for example, is going to sit in escrow, and then they would release that per the terms of the contract. So they're the interpreter. Or if the contract canceled and there was a valid reason to back out, they would refund that money back to the buyers. So again, they're that neutral third party there for us. Now, some of the other key things that escrow does for us is they're going to help to work directly with the title company. Oftentimes, you'll see it's this title and escrow company are the same company. And what that's doing is verifying, liens, judgments, easements, issues with the property, the title of the property you're buying. So they're going to be very involved with the title company to make sure that's cleared as well prior to closing. Now, some of the other key pieces for us is as it goes through the closing process, they are going to facilitate all the notarization of the documents with you. The final docs that need to be signed, we as lenders email those to escrow. They will print those out. They will have their own escrow and title docs, add in the loan documents, and have a final signing package. So they manage kind of the distribution of funds as a neutral third party. They facilitate the notarization of both buyers and sellers. Then that final component is as we as a lender fund and you send in the down payment, now they will record final documents with the county. So they will take all the final deeds of trust and other documents, record those with the county, and verify once they're recorded that it's officially closed transaction. Then they release the funds out. So really, I like to think of them again as that neutral third party, but kind of a behind the scenes facilitator of everything from dispersing money left and right per the contract to helping record the documents with the county and to obviously get buyers and sellers to sign. So a lot of that transaction management. So that's the role of an escrow company, guys. Again, it is required in Washington State, absolutely for a good reason. And that's kind of the main few roles they do. Now, switching gears a little bit is now say we've closed our house, we have a loan, or on your current loan now, most loans have what we call an escrow account, other times called an impound account. So it can be a little bit confusing because technically this is different than an escrow service of closing, has a similar name though. So what this escrow account or impound account does is taxes and insurance in states are due in different times of the year. For example, in Washington, 6 months are due in April, 6 months of taxes are due in October. Also, your home insurance is due once annually. So there's 3 big payments a year that clients would need to make. Well, instead of a client having to come up with these 3 lump sums, it is customary where they pay 1/12 of their mortgage as part of their monthly payment. Well, what is actually happening, guys, is you're making that payment and the 1/12 tax and 1/12 insurance is going into this side impound account. Now, this is typically managed by the loan servicer. So whoever you're making your mortgage payment to, they're moving the funds over 1/12, 1/12, 1/12. That account is slowly building up. Now, when April rolls around and taxes are due, they, on your behalf, pay the taxes directly to the county. Your account balance drops back down, continues to build up. So really at closing, you would set up this impound account balance so it's on track that moving forward as a client, you just make your 1/12 payment as part of your mortgage. The funds slowly build up. They're dispersed out when they're due April, October, and annually for insurance, and it comes back down. So it's a really cool way of kind of auto budgeting. Now, this is done for 2 main reasons. One, it's just much simpler for a client. They don't have to make lump sums. They just pay their mortgage. But the second piece is lenders do prefer it to say, hey, if we as a lender are in charge of paying the taxes, we know they're always going to be paid on time. Even if you were to default on your payment, we're still going to pay taxes, so there's no tax liens. Secondly, for home insurance, well, it's obviously important that insurance doesn't lapse because not only is it your home, it's the collateral of the bank, or the lender. So they want to ensure that's paid. So lenders do prefer to do it to make it easier for clients, but also to ensure taxes and insurance are always paid timely. So on your mortgage statement, you will see the accounting of this. You'll see the balance will show growing. Then you'll see, okay, minus $3,000 paid to King County, for example. You'll see that tracking. I always like to let clients know too, at any point when you guys sell, refinance, or pay this off, legally the balance in that account is yours. It'll be refunded to you. But keep in mind, it's never typically giant, right? Because it's just slowly building up and then depleted. But that's the purpose of an impound account. Again, sometimes referenced escrow account. So I hope that gives you guys some updates today on kind of what's an escrow closing look like and what's their roles. Separately, what's that impound account. As always, any questions, scenarios, please feel free to reach out and we're always happy to help.